Hi all, in this exercise we are going to learn about credit modeling of Sealed Air. Sealed Air is a packaging company mainly known for its food packaging and bubble wrap packaging, and it is a US based company. And in this exercise we are going to create detailed financial model from credit research perspective. But before we move ahead, I just want to clarify a few things. In the investment management there are two major asset classes. One is equity, other is fixed income securities. So both these securities reflect very different risk and return profile. Why? Because investors, those who invest in equity, they take more risk due to volatile stock market. Whereas bonds, which are fixed income securities, provide steady but moderate return. And in this exercise, our focus will be credit research and the fixed income securities and the bond valuation. So here in this exercise, we are going to use substantial data points. I just want to highlight few key points which I am going to cover in session 1. I have already data from income statement, balance sheet and cash flow. This is all historical data which is sourced from company filings, and the company filings are very well available on the company's website for any listed company. So we can easily source this data. On the basis of this data, we are trying to understand what all are the revenue and cost drivers for the company, and basis on both of this we are going to make simplistic assumptions around this data to do our forecasting. Now please understand that our focus will not be what assumptions we are taking, but our focus will be how we are taking that assumptions, how we are using it to forecast, and how we are tying a model from top to bottom, how we are linking each and every assumptions with the three financial statements, which are income statement, balance sheet, and cash flow. So please remember that this session is a quick way to analyze any company from credit perspective. You can always refine it more at your end. For example, you can always refine the assumptions basis on your understanding about the company and about the sector. And developing an understanding require intense reading about both company and the industry. So do understand that we have a limited time to address this problem. So obviously it might leave some moving and here and there, but that is okay. We are just creating a template for financial statement analysis, which can be used to analyze any other company using this template. So that's broadly the contour of our discussion. Let's spend some time to understand what all data we have. So here in the income statement, the profit and loss account of the company, we have data from 2015 till 2017. This is the last 3 years data we already have. All this data is available in USD million. So at the end of 2017, the company generated 4,462 million of revenue, or I can say 4.5 billion of revenue. In terms of profit, the company generated profit of 63 million at the end of 2017. So obviously when we'll see from last 3 years profits are declining, we will come on this later. In terms of revenue for 2016, revenue has gone down because of the lower price mix and because of certain divestitures. But in 2017, the company has shown again the healthy increase in revenue, and margins are also healthy. So this is largely the size and scale about the operations of Sealed Air. Now we will look at balance sheet. On the balance sheet, first we will look at sources of fund. So here few things strikes us very clearly. Um, the companies have a significant amount of debt. The company's total balance sheet size, 60% of the company's balance sheet is funded through debt. And apart from this, the company also have accounts payable, other current liabilities, other non-current liabilities. These are all part of current liabilities and long-term liabilities. So from the credit research perspective, the company's debt The company's long-term debt is very, very important to understand, and we are going to analyze this in detailed capital structure analysis. What is the debt hierarchy of the company? How the company has funded in its debt? What all are the loans and bonds are available in the company? Now, if we look at the asset side of the balance sheet, again, the balance sheet size is 5.2 billion, and the major part of the balance sheet is coming from goodwill, uh, property, plant and equipment, inventories, receivables, and cash. So, company has a healthy balance of cash. Company has almost 11% of its balance sheet size is cash, which is quite healthy. Company has certain receivables, which means on the sale of in 2017, at the end of 2017, on the sale of 4.4 billion, the company had receivables of 552 billion, which this is the amount which is not paid by the customers yet. As soon as the company will get this amount, this will be part of cash and it will be completely wiped out from the receivables. Similarly, the company has inventory balance of almost 500 million, which means company needs to maintain almost 10% of its balance sheet size as a inventories for the sale of 4.4 billion. Now, the company has a goodwill which is almost 40% of the total balance sheet size. The company has a goodwill of 1.9 billion. What does it mean? It means the company goodwill means the company's reputation. When we are going to sell a business in the market, we are able to sell it at a higher cost rather than the worth of the identifiable assets. The amount which is not justified from the identifiable of assets are the company's goodwill, which is company's reputation. And on the stockholders' equity, company almost 33% is shareholders' equity. The company has retained earnings of again almost 30%. Retained earnings are nothing but the accumulated earning of the company's as net income since its inception after paying the dividends. So now we will look at cash flow statement. Cash flow statement is broadly divided into three parts: cash flow from operating activity, cash flow from investing activity, and cash flow from financing activity. So cash flow from operating activity, there are three things which is very, very important to understand. One is net income, depreciation and amortization of the company, and the working capital need of the company. Working capital is nothing but the change in current assets and current liabilities, how efficiently company is managing its working capital, that we are going to understand in our assumptions when we are going to uh, do forecasting related to working capital. But here it is just I'm just giving you an idea what all are the key things which we need to understand while working on cash flow from operating activity. Now, the second part is cash flow from investing activity. In the cash flow from investing activity, we need to understand and we need to forecast as well, like what is the capital expenditure historically and what is the capital expenditure plan for the company. What all disposals company is doing for its property, plant and equipment, and the business, any major business divisions, or is there any acquisition the company has done or company has announced which is going to happen in coming period. That is all part of cash flow from investing activities. Now, third and very important part of cash flow statement is cash flow from financing activity. This is very important from credit research perspective because this part is going to tell us how much debt company is planning to repay or already repaid in the historical period. Is there any new debt issuance company is going to do? If it is expected, then it is going to come here. Any if company whether company is doing any dividend payment to its common stockholders. If yes, then we need to make assumptions around that. Is company is purchasing its stock or issuing new stock? That all will come here and that we need to look into this in detail. So this is broadly about the cash flow statement. We also have ratios with us. In the ratios, we have profitability ratio, balance sheet ratio, solvency ratio, turnover ratio, and few more other ratios we have. In the profitability ratios, all the margins look healthy. Gross margin 2017 slightly declined. Operating profit margin again slightly declined, but EBITDA margins are largely stable. Net profit margins are increasing. It is improving, which is good for the company. On the balance sheet side, all the leverage ratios, especially total debt to EBITDA, net debt to EBITDA, and interest coverage ratios, all three of ratios are showing improvement, which is a good sign for the company. On solvency ratios, quick ratios and current ratios both looks healthy, and current ratio is above 1 and quick ratio is almost near to 1, and it is attain under the range of 1.8 to 1, which also looks healthy. And we also have turnover ratios. Apart from that, there are certain return ratios which we can calculate basis on the available formulas which we have here. So this is broadly about the company's historical data, income statement, balance sheet, cash flow, and ratios. Now we are going to look at the assumption part and how we are going to do the forecasting. In the assumption part, first we will look revenue bifurcation as per the segment. So first we are going doing forecasting for the income statement, and in the income statement we will look at the revenue and cost drivers and how we can forecast it, how the company is generating revenue, from which all the segments the company is generating revenue, that we are going to look at. So in the assumptions, I have revenue bifurcation for the company's segment. The company has two segments, food care and product care, and I have the total revenue. So what I can do is, first I can calculate the year on year growth for the total revenue, which will give me an idea how the revenue is moving. I have calculated in 2016 the revenue has gone down by 4.5%, but in 2017 again it has increased by 5.6%, which shows that the company has shown a healthy increase in the revenue in 2017. 2016 it was gone down because of the certain business divestiture, segment divestitures, and because of the lower price mix. And in its for going forward for 2018 and 19, now how to make an assumption, how we are going to do the forecast. So here I just want to highlight, for any company which belongs to any specific industry, there are multiple things which played in to do forecasting. For example, in this case, the sealed air, we know that this company is in packaging and it has two divisions. And it's if we'll check company's filings, its PPT, company in its PPT shows the 2018 financial outlook, in which it clearly shows for 2018 the net sales the company expect is between 4.7 to 4.8 billion. So what we can do, as being in conservative side, we can assume that company is going to report at the lower end of this range. So I will assume 6% of the revenue growth in 2018, and again 6% in 2019. Whatever the assumptions I'm going to take, I'm going to put it in red just to distinguish from the historical data. Now I'm going to forecast this. This is my revenue for 2018, which is still on the lower end of the given range, or the provided range by the company. So I can say that, as being on a conservative side, I am correct. I can forecast this revenue. Now, about these two segments, we have the revenue bifurcation. From this, I have no reason to believe or to think that this bifurcation is going to change drastically in the coming period, because historically also, if I'll see from the food care, the company is generating revenue between the range of 60 to 65%, and from the product care also the company is generating revenue between 35 to 37%. So it largely historically remains same. Going forward also I can assume it same, so that I can get my revenue forecast easily for the 2018 and 2019. So here we have forecasted net sales or revenue for the company. Now we are going to look at the cost drivers. The company's what all are the cost drivers? When I'll see the company's cost of goods sold, which is a major cost for the company. After that, there is selling general administration expenses. After that, amortization expense of intangible asset, which we can ignore now, and restructuring and other charges. Restructuring and other charges are all one-time charges, which also we can ignore. And if we'll see the amount, these are also very minimal, very meager amount, so we can ignore. We will forecast only the major line items. So here in assumptions, cost of goods sold, historical data I already have. I can calculate the ratio of this cost of goods sold based on the company's net sale. What does it mean? That the companies in 2015, for total sale of 4.4 billion, the company's cost was 67%. Company's gross cost of sales was 67% of the total revenue. I'll drag this and I'll see the trend. Yes, in historically also it is not changing much. It is range bound from 67 to 68%. Going forward period also, I can assume it almost near to 68%. And for 2019 also I can assume the same. Now I can back calculate on the basis of the revenue which I have already calculated. I can calculate my cost of goods sold. So I got the cost of goods sold and I'll drag this here. Now, I have already calculated cost of goods sold. Now I will calculate selling general and administration expenses. This also I will take it as a percentage of sales. I will take it and I will the fix the line but not the column. Okay. So it is 17.6%. I'll drag this and I again got this percentage. If you'll see, this is also range bound. 17, almost 17%, 17.6 to 17.8. I'm going to assume the same going forward also, because as such I have no reason to believe that it is going to change this drastically until and unless company is mentioning its company filing that it is changing. So here I'll back calculate on the basis of the revenue. I'll calculate the SG&A, which is selling general and administration expenses, and I'm going to drag it here. Now here I got my revenue and cost for the period of 2018 and 19. Now I can easily link it with my income statement because I have all the data. So I'm going to link it, which is very easy. I just linked it and I'll drag it. Similarly, I will link the revenue for the other segment also, which is also very easy. I have linked and I have dragged it. Now I'm going to calculate the total revenue. I'll just check it whether it matches or no. As far as cost of goods sold is concerned, again I'm going to link it. I am going to put a negative sign because it is a cost, and I'm going to link it with cost of goods sold. I'm going to drag this. With this, I'm going to get my gross profit. I can calculate my gross margins just to get an idea whether I'm in line with historical period or no. Yes, historically the company is generating gross margins of 32 to 33%, and for going forward for our forecasting 18 and 19 also our gross margins are in line with historical data. So I am in right path. Now I'm going to link my selling general administration expenses also from assumptions because I already have this data. So link it the same way we have done it for cost of goods sold. It is very easy. We can do it, and I have linked and I have dragged it. For a time being, we are going to assume amortization expenses of intangible assets as zero. Uh, Restructuring charges also as zero, because as such we are not expecting any restructuring to happen in the coming period, because company is not guiding related to this anything. Now, in the income statement, I have revenue, I have cost, I have cost of goods sold, and I have operating cost. What I do not have, and what is important to forecast here is, one is interest expenses, other is income tax provisions. These two are the major line items which we need to forecast. Other line items like in interest income, foreign currency exchange charge related to any subsidiary, these are hardly and minor amounts. These are all very small and meager amounts, and we can ignore, and we can put it zero. For a time being, I'll just drag the formula so that I can make it look complete. So now interest expenses and tax provision, these two things are left. Interest expenses we are going to forecast in the assumptions, and tax calculation is very easy. We can straightforward, we can take 30% of our EBIT expenditure, EBIT earning before taxes. We can straightforward, we can take 30% of that. So that is easy. We can do that. I have dragged it. I just checked here, and this way it looks complete. The only thing which left is interest expenses, which we are going to forecast in the assumptions when we will look at the debt part of the company. So in the income statement, technically we have looked into revenue and cost drivers. We have forecasted these numbers in assumptions, and we have plugged in these numbers for 2018 and 19. These assumptions may not be correct 100%, but at least we have built a framework. Here I just want to highlight, in Sealed Air, the revenue and cost drivers are very simple, but in your company, there could be more number of items in the operating cost. You can assume it as a percentage of revenue, which you have done it here. So that is very much possible. And as far as different companies of different sectors are concerned, the revenue and cost drivers are very much dependent on the sector. For example, if a company belongs to an auto sector company, so to forecast the revenue of a auto sector company, we just need to look into the volume and per unit cost or per unit price of that particular vehicle in that particular company. So we need to do forecasting accordingly. Similarly, in a metal and mining company, we need to check the production volume of the company and the commodity prices, prevailing commodity prices, and what is expected in the coming period. We need to look into that, and accordingly we need to do revenue forecasting. But here we have built a framework that will help us to go one step higher, and now we will look into the balance sheet numbers. In the balance sheet I can divide broadly in three categories: current assets and current liabilities, long-term assets and long-term liabilities. My current assets and current liabilities will be projected with the help of working capital. When we will work in the working capital and the projections of that, we can easily plug these numbers in the balance sheet side of current assets and current liability. Apart from that, in the long term liabilities, we have long term debt. This we are going to look into it separately when we are going to when we are going to project the interest cost, and we are going to see the maturity profile of the debt, current debt in the coming period, in the coming 1 or 2 years. Apart from that, on the liability side, in the shareholders equity, which is going to remain constant, assuming the company is not issuing any new debt and company has not purchased any new debt. Retained earnings, as I already told you, it is nothing but the accumulation of the net income. We will come into this when we are going to project. So in the balance sheet, there are certain line items which we need to keep it constant because there is no real benefit it to project it, and there are certain line items which we are going to work on those and we are going to project. But when you're working on a balance sheet, always remember the Pareto principle, which is 80-20, which means 20% of your line items will going to have a 80% of the impact. For example, for example, like other receivables. This is a very small amount. It is just 2% of the total balance sheet size. So there, as such, there is no benefit to spend too much time on this until unless you think that it is going to become a very or a big number going forward. Similarly, assets held for sale. Assets held for sale is nothing but the company's assets of a division which company is sold recently. For example, in this case, in Sealed Air, company has recently in 2017, September 2017, sold its one of its division. Right now, there are two divisions are appearing: food care and product care. They had one more division, diversity business. So that is basically related to hygienic products that the company has acquired in 2011 and they have divested it in September 2017. So they have they have categorized those assets, this and this non-current assets held for sale. This all this both the assets are part of the diversity which business which company has categorized it to sale, and it is already sold in September 2017. So if you will see in 2017 it is completely wiped out, and here in 2016 it is classified assets held for sale. So these are the asset side. Similarly, on the liability side also, the company has classified certain liabilities for sale. Current liabilities held for sale and non-current liabilities held for sale. So these are the line items which we cannot project until and unless we have information about this. So while working on the balance sheet, we will keep in mind that there are certain line items which we are going to keep it constant. Remaining, we are going to project, and the line items which I expect remain to be constant, I'm going to plug in those numbers. I'm not going to break too much my head into that. So in the balance sheet broadly, there are two line items which we need to forecast. One is working capital, other is capex. Capex is required to forecast the property, plant, and equipment, and working capital is forecasting is required to forecast current assets and current liability. So first we will look into the working capital requirement. Now, what is working capital? Just logically think, what is working capital? Suppose a company is generating a revenue of 100 and company is maintaining on the revenue of 100, company is maintaining inventories of 10, which means if the company is going to generate revenue of 200, company needs to maintain an inventory of 20, right? Similarly, if the company is generating a revenue of 100 and company has a receivables of 20, which means as the sale of the company will increase to 200, this receivables are also going to increase in that particular proportion, right? So in working capital, we are going to assume all the current assets and current liabilities item as a percentage of sale. We will calculate this receivables as a percentage of sale. So similarly, I have done it here and I have dragged it here. Now, if we'll see receivables as a percentage of sales, uh, it is in a declining trend. It is declined in 2016 and after that it is increased slightly. So as being on a conservative side, I can assume that it will going to remain constant as last year. Similarly, inventories is also range bound. It is moving between 10 to 15%. Accounts payable is also moving from 12 to 16%, and other current liabilities also. So I can assume that it is going to remain remains same as last year. If we want, we can take an average also. For example, here we can take average of the last 3 years as well. This is an average. Okay, so for a time being here, as being as keeping the assumptions very simple, I assume that it is going to remain constant as last year, and I'm going to on the basis of these assumptions which are mentioned in red, I'm going to back calculate my current assets and current liabilities. So how to back calculate? It is very simple. Just multiply receivables by the sales. Net sales, I can freeze it because I can freeze the row rather than the column. So if I'm freezing the row, I can calculate it. I can drag this. I can drag this also. I can check if the formula is correctly applied. I can apply it here. It is moved because there are two blank lines here. I can shift this cell here and I can drag it. So this way I have calculated my current assets and current liabilities. Now here in current assets, apart from trade receivables, there are income tax receivables, other receivables. I have kept it constant because these are minor items, and if you want, you can again you can calculate it, but for the sake of simplicity, I have just forecasted trade receivables, and rest two items, income tax receivables and other receivables, I kept it constant. Now I have already forecasted these numbers. Here I am going to calculate the working capital. Working capital requirement is nothing but um, your current assets minus your current liabilities. So basically it shows that how efficiently company can manage its current liabilities through its current assets. If it is negative, that means it company is not managing its current liabilities through its current assets. Now I have these numbers. This is very simple. I'm going to plug in these numbers here to get 2018 data. I need to be little careful while linking the working capital numbers in the balance sheet. Here is my trade receivables. I have forecasted. I'll just make it formatting correct. I'll drag it. Similarly, I can plug in inventory as well. Inventory is here. I can drag this. So I have forecasted my current assets for 2018 are correct, complete except cash and cash equivalent. This we are going to get from the cash flow statement. Now I'll go to current liabilities, and in the current liabilities I will plug in accounts payable data, which is here, and other current liabilities, which is here. I have plugged in this data, and on the liability side also my balance sheet is complete apart from the long-term debt. So that is all about current assets and current liabilities. Here in the assumption side, I'll just highlight this part. Here in the working capital, one more thing I just want to clarify. For a good company, usually the good companies keep their working capital numbers, receivables, inventory, payable numbers constant. For not so good company, the numbers move here and there, but it is very difficult to predict. But for a sake of simplicity, or for after reading about the company's transcript, its guidance, we can make certain assumptions. Here I kept it conservative, and I just made the simplistic assumptions same as the last year. And here I have calculated working capital. Now I can also calculate here the change in working capital. Change in working capital is nothing but which shows whether the change in working capital is a source or a use of money for the company. For example, here, so here from in 2016 it is positive 6, in 2017 it is positive, and then 2018 and 19 also it is coming positive. What does it show? For 16 and 17, when I'm looking at it is positive, it shows that company is generating cash from its internal operations. If I'll see the receivables, receivables are declining. Receivables is declining, that means company is getting cash quickly. Inventory is declining, which means inventory is quickly turning into sale, which is generating cash for the company. Payables are declining, which means the company is paying the cash, that means cash is moving out of the business. If cash is here from 16 to 17, it is increasing from 539 to 724. What does it show? It show the payables are increasing, that means cash is accumulated, company hasn't paid that, so it is helping to keep the working capital positive. So that is all about the working capital. Here in the balance sheet, we have plugged in almost each and every number for 2018, but I have purposefully ignored cash and cash equivalent, which will come from cash flow statement. I have ignored property, plant and equipment, which will come from my capex calculation and capex assumptions. And I have also ignored long-term debt, which will come when I am going to calculate the interest expenses on the debt, and I'm going to calculate how much debt company is going to repay this year and how much going to be outstanding at the end of 2018. So broadly, in the balance sheet, there are three line items which we need to project. One is cash and cash equivalent. Second is property, plant and equipment. And third is the debt part. So I'll come to property, plant and equipment, and I'm going to check my capex requirement. Here, this is a depreciation and capex schedule which I have prepared. Depreciation we have taken from the income statement where we had the numbers, historical depreciation and amortization number we had from the company filing. We have taken it there. Now I have calculated this depreciation rate. How we calculate the depreciation rate, I'll just show you. Uh, we take the depreciation amount divided by the last year capex plus the capital expenditure happened in that particular year plus the disposables the company has done. It is basically negative. We have kept the disposables negative, so when we are going to keep it as plus, it is going to be deducted from the property, plant and equipment. So this way I got depreciation rate of 12.7%, and for 2017 it is 14.1%. Capital expenditure, we already have capital expenditure from cash flow from investing activity. We have just linked it from here to this place. Now, how to project a capital expenditure? Usually, we take it capital expenditure as a percentage of revenue. So here we have the revenue. I have just calculated the percentage and I will drag this. So if I'll see, the company's capital expenditure is basically moving from 4 to 6.5%. For 2018, for how to assume for 2018? Usually in their guidance, company usually provide their guidance and they show how much capital expenditure they are going to do in a coming period. So if I look at the Q1 2018 PPT, the company is providing its guidance from total for 2018 outlook. For the free cash flow, the company has given their guidance of capex of 160 million. Either we can assume, we can directly plug in that 160 here, or we can, if we do not have this number here, if the company is not guiding, then we can assume certain rate here, for example 5%, and we can back calculate this multiplied by the revenue. So this is a higher number. If I'll change it to 4%, it is still not coming near to 160. So 160 will be almost, should be 3.5%, I guess. Yes. So almost 3.5% is near to 160. So we can assume that 3.5% the capital expenditure the company is expected to do in 2018 and 2019. Now, disposals. From where these disposals come? These disposals come from the cash flow statement, from the cash flow from investing activity. Proceeds from sale of property and equipment. These are the disposals the company has done. For going forward, for 2018 and 19, we can assume that the disposals are zero. That company is not going to dispose anything. Now, we need to project the depreciation rate. How much depreciation we are expecting? I can, to be on a safer side, I can assume 14%, same as the last year. Now, I can calculate my depreciation. How am I going to calculate this depreciation rate multiplied by property, plant, and equipment of last year's ending balance plus the capital expenditure which is expected this year minus the disposals which are going to happen. I can keep it as plus because these are in negative, and I will calculate my depreciation. So I have calculated my depreciation. I'll drag it. Now I can easily calculate what is my property, plant, and equipment. It is nothing but property, plant, and equipment is nothing but last year's balance plus the capital expenditure this year plus the disposals which are in a negative minus my depreciation. This is my capital expenditure at the end of 2018 which we expect. So I get my property, plant, and equipment. I'm going to plug this number here from the assumptions, which is very easy. I'm going to plug it. I'm going to drag it. So this way I got my property, plant, and equipment. Now on the balance sheet side, on the asset side, we have only cash and cash equivalent which we need to project, which will come from the cash flow statement. Otherwise, the asset side is complete. On the liability side, our long-term debt, which is still pending to forecast. So now we are going to look into this, how we are going to project the liabilities. So for that we will create our interest expense schedule. In that interest expense schedule, we have already taken this interest expenses from the income statement. Interest expenses are available here. We have taken from there. Now our total debt is coming from our balance sheet. So these are the debt which is flowing here. Now we will calculate the average interest cost on this our interest cost on the average debt. So to calculate that, I will calculate interest expenses divided by the average of the last year's and this year's, I mean 2016's debt. So this way I have calculated the average interest cost of on the average debt of 5%. I'll drag it, and I see, I have noticed that it is increasing in 2017. Now the company's total debt is in declining trend, which will give me an idea how much debt the company is repaying. For example, here the company has repaid this minus this much debt. The company has almost 500 million of debt company has repaid in 16, and 532 million has repaid in 17. Now I need to look at how much company is going to repay in 2018. So for that I have a debt maturity. I have a debt maturity uh, schedule here, where the company shows that in 2018 they are going to repay 2 million of debt, and 2019 they are going to repay 223 million of debt. So I'm going to plug in this numbers from here to there, and I'll drag it so that I'll get an idea in is 18 and 19 how much debt is going to repay. So from this, I can calculate my debt for 2018, the last year's balance minus this year's repayment, which is going to happen. Similarly, for 2019 also, I can calculate, I'll just drag and I can calculate this. Now I can assume that the company's average interest cost is going to remain same as last year, which is 5.8%. Please remember that all the assumptions which I am taking, I am keeping it in red for the sake of simplicity, and all the calculations are in black color. So here now I can calculate my interest expenses. How am I going to calculate? Interest cost multiplied by average debt of this year and last year. So this will give me the uh, interest expense calculation to me. And here from here I calculated the total debt amount at the end of 17, at the end of 18 and 19. I'm going to plug in these numbers in the balance sheet, which is very easy. I'm going to plug these numbers. I'll just link it. I will plug this number here and I'll drag it, which will give me in 2019 figure as well. I do understand all the 2019 figures I have not plugged in. Maybe I'll quickly just plug in so that it will look complete. I will drag it. Similarly, these also I will just drag it. These all going to remain same. This all going to remain same. These three going to remain same. Accounts payable we have already forecasted. I'll just drag it, and other accounts receive other current liabilities are also we have forecasted. So I will drag it. Long-term liabilities we have, deferred taxes we are going to keep it constant. Rest other long-term liabilities we are going to keep constant for the sake of simplicity. Now common stock also going to remain same until unless company is not issuing any debt. Uh, Common stock in treasury will also going to remain same. Accumulated other comprehensive income will also going to remain same. Now from in the current assets and sorry, in the assets and liability we have forecasted each and every line item apart from cash and cash equivalent. This we will come later. We will forecast this in the cash flow statement, but we will look into the retained earning. Before we forecast retained earning, we need to finish our income statement also. What was left in the income statement, interest expenses were left. We are going to link it with the interest expenses which we have just now calculated in the assumption side. So I'll just link it. I'll just format it. This will give me my net earnings, and this way I got my income statement is totally complete and my balance sheet is largely complete apart from cash and cash equivalent and retained earnings. Now, before I forecast cash and cash equivalent and the retained earnings, I plug in the numbers. I need to look into the cash flow statement, which I haven't looked at it yet. But as I discussed earlier as well, in the cash flow statement, in the cash flow from operating activity, there are three major line items which I need to forecast: income statement, net income, depreciation and amortization, and the working capital. These are the three major line items which I need to forecast. So I already have forecasted in the assumption tab. I can easily plug in this numbers. Net income will come from the income statement. Here it will come from here, but in the income statement maybe I can here assume that gain on the sale of discontinued operation zero, because I'm not expecting any operations this year, so I can assume it zero and I can drag this. So this way I'll get the net income. I'm going to link it with the cash flow statement. I have linked it and I will drag it. Similarly, depreciation and amortization we have forecasted and we have this in our assumption tab. We will link it with here assumptions, and I'll cross check it. I just need to be little careful while making all this linking so that everything is correct and ultimately our balance sheet matches. Now, this is change in working capital. So what I'll do it, I'll merge these cells and I'll just put the number which I have calculated on the assumption tab. Change in working capital is nothing but which is 16 for the period of 2018. So I'll plug in this number there. This consists of the change in working capital from the last year to this year, and I'll drag it. I'll drag the formula for the cash flow from operating activity, and I'll see that I got the numbers here. Now, in the cash flow from investing activities, the major important thing is capital expenditure. We have already looked into this. We will just plug in that number here so that uh, we can complete the cash flow statement as well. I have just plugged in uh, proceeds from sale of the disposals. Basically, I have assumed it zero. So I'm going to plug in zero here. Rest other all the line items. Proceeds from the sale of the business. I'm not expecting that company is going to sell any business in 2018 and 19. So I kept it zero. Business acquired in purchase transaction and the impact of sale of diversity. These two line items, basically the company has impact of sale of diversity. The company had a division of diversity, as I said earlier also, which they have sold in 2017. That is why 2 billion amount is appearing here. But in 18 and 19, I am not expecting, until and unless company is specifically mentioning in its outlook or the guidance that they are going to spin off any business, I'm going to assume it zero. So we have assumed it zero. Other activities also I will assume zero. And business acquired in purchase transactions, this also I'm not expecting that company is going to acquire any other business this year, so I can safely assume it zero. And I'll just calculate the investing cash flow from investing activities. So this way I have calculated cash flow from operating activity, cash flow from investing activity. Now we will look into cash flow from financing activity, which is very important from the credit perspective. So the first line is net payment proceeds from the short-term borrowing. As such, from the short-term borrowing, we are not expecting anything to be paid or to be received. Proceeds from long-term borrowing, we are not expecting company to issue new debt. So I can safely assume it zero. If company is issuing any new debt, that you need, then you need to plug in that number here. Now, repayment of long-term debt. We already know, and we have done this in our assumption that company is repaying 2 million of debt in 2018. So we are going to plug in this number here and we are going to drag it. As far as company's dividend on the common stock is concerned, we'll see company's history here. The company is paying from last 3 years, company is paying regularly dividends. We can safely assume that this year also company is going to pay the same amount of dividend, and it is not going to change. Here, purchase of common stock. purchase of common stock, if you'll see the company's history last 3 years, company is repurchasing the common stock. That means it might possible this year and next year also company can purchase, but for that we need to look into the company's filing and the outlook. If they are saying that they're supposed to repurchase certain amount of common stock, we will plug in here. Otherwise, for a time being, I'm going to assume it 0, and then we will see whether we are able to finish the template as a whole or no. Similarly, payment of debt issuance, as such there is no payment cost involved here because we are not expecting any major repayment, so we will assume it 0. Other financing activity, which is not a major amount, we can assume it 0, and we can calculate the cash flow from financing activity. I'll just drag it, and this way I have calculated cash flow from operating activity, cash flow from investing activity, and cash flow from financing activity. Now I need to calculate the ending cash balance, which will directly go in the balance sheet. For that, to complete that, here the effect of foreign currency exchange, again I can safely assume it 0. I will calculate the net change in cash and cash equivalent. I'll just drag this formula, and I can calculate this. And now the beginning balance of cash beginning balance in the starting of 2018 will be nothing but the ending balance of cash at the end of 2017. So I'm going to just link it here, and I'll drag it. Now I will calculate the ending balance, which is nothing but the change in cash flow of activities plus the ending balance of last year, and I got my this thing, the ending cash balance. So I got the ending cash balance. I can easily plug in these numbers in the balance sheet, isn't it? I'll go to the balance sheet, and here on the asset side, on the current asset side, cash and cash equivalent, I'll plug in this number. From here I'll just link it, and I'll plug in this number. So this will complete my asset side. Now now I need to look into the retained earning. What is retained earning and how I need to project it? For projecting the retained earning, we will take last year's retained earning plus this year net profit or net income from the income statement. We are going to link it, and from this, how much how much company has paid in terms of dividend, which we are going to link from the cash flow statement. Dividends are here. We are going to link it, the dividend which is paid to the common stockholders. The moment I plugged in my balance sheet balanced, and here it is 0, that means my balance sheet is balanced. So in terms of template, I have finished it, and it is matching also. For 2019 it is not matching. Okay, here we have not plugged in the total liability number. As I drag the formula here, it is matching. Bingo, our balance sheet is complete and our template is ready to do analysis, and to do analysis for any other company as well. So now in terms of template, I have completed my income statement, balance sheet, and cash flow. Balance sheet is matching. So that's broadly it. I supposed to cover in this session. In the second session, our second session's focus will be more on the EBITDA calculations, free cash flows, the importance of free cash flows, what is the difference between free cash flow to firm and free cash flow to equity. We will also look into the detailed capital structure analysis, all the off balance sheet adjustment, what all are the importance of those, and how we create a debt maturity and liquidity profile. And in the end, we will see the bonds. What exactly is happening with the bonds, where these are trading.